Gold is at $4,999, $1. That is all that separates the most psychologically significant level in this entire bull market from a clean break lower. $1. OG John AG here. Drop OG John AG in the comments if you are here paying attention and actually learning. Now, gold dropped 3.2% in a single session after the Fed decision. Let's get straight into it. Before we go further, if this kind of data-first analysis is what you have been looking for, hit the like button right now. Subscribe to OG John AG 1.0 and share this with one person who needs to see these numbers. Now, back to the data. Lead story today, the Federal Reserve. Rate held at 3.5 to 3.75% on March 18th. That was expected. What was not expected? 7 of 19 FOMC members now project zero rate cuts in 2026. That is one more than December's dot plot. Then February PPI dropped. Core producer prices running at 3.9% year-on-year, well above every major forecast. Gold dropped 3.2% on the session, touched $4,837 before recovering. It is now sitting at $4,999. The timing is what deserves scrutiny, not the hold, not the PPI number alone. The timing. Both signals landed within 24 hours of each other. Think about what that sequence actually means. A Fed that cannot cut because inflation is still running hot. A dollar that immediately strengthened on that confirmation. And gold, which had been holding $5,000 as a floor, suddenly finding itself defending that same level as a ceiling. The ones paying attention already know what to watch next. Before I show you the full data picture, consider this. The last time the US dollar index surged 5% in under 30 days, gold corrected between 8 and 12% before finding structural support. The DXY has moved from 96 to 100.18 in under 30 days. The data is already telling you something. Let's build it out. Now let's build the full picture because the Fed decision does not exist in a vacuum. The US dollar index, tracked by ICE Futures US, is at 100.18. That is up from 96 in mid-February, a 5+% move in the dollar in under 30 days. The US Treasury 10-year yield, published daily by the US Department of the Treasury, sits at 4.26% as of March 19th, up 0.057 on the session alone. COMEX gold open interest, data published by the CME Group, remains elevated with speculative long positions built during the Iran conflict geopolitical premium phase. Those positions are now sitting in a dollar-strengthening, yield-rising environment. That is not where they were built to sit. February producer price index data from the U.S. Bureau of Labor Statistics confirmed core PPI at 3.9% annually. That number destroyed any remaining near-term rate cut thesis. The rate of dollar strengthening is not slowing, it is compounding. The data is doing the talking. The ones who called for gold at $5,000 and were told that was unrealistic. They are not the ones arguing right now. And here is what makes that picture even harder to ignore. The Shanghai Gold Exchange continues to price gold at an estimated $10 to $25 per ounce above COMEX spot. That is the physical premium. Chinese central bank accumulation and institutional demand in Asia are absorbing every dollar of Western futures-driven selling in real time. At the same time, COMEX open interest is elevated while the dollar surges and yields rise. That is not a contradiction. That is the setup. Physical demand in the East is holding a floor that paper markets in the West are currently testing from above. And before anyone takes that as a green light to add exposure, setups can take a long time to resolve. What this tells you is the structural picture. The timing is a completely separate question. Anyone who claims to know the timing is selling something. Now the Iran conflict, but because this is no longer a backdrop, it is the primary variable. Here is the number most people are not talking about. 21 million barrels per day through the Strait of Hormuz. If that number changes, everything reprices. Oil is currently trading above $97 per barrel on Brent crude. In-session spikes have touched above $104 intraday on fresh strike reports confirmed by Reuters. The Fed's own March statement acknowledged, and this is specific, that the ongoing tension between its inflation and employment mandates has become harder to assess amid the conflict in Iran and resulting oil price volatility. Powell said that, on the record, markets are still pricing a relatively contained conflict scenario. Look at oil at $97 and tell me what probability you put on that containment holding through a full weekend with markets closed. When markets start pricing the reality of what sustained oil above $100 means for core inflation, gold reprices higher on safe haven demand. The dollar reprices on stagflation risk. That is the historical pattern. Every time oil has surged above $100 on a geopolitical supply shock, it has not been different yet. Gold Western Spot at $4,999. Shanghai Gold Exchange estimated at $5,010 to $5,025. A $10 to $25 physical premium confirmed. Short-term picture, the $4,980 to $5,000 support zone is the only level that matters right now. If gold closes the week below $4,980 on a clean weekly basis, the next structural support is $4,750 to $4,850. If the dollar reverses below 98 and Iran developments reduce the oil risk premium, gold moves back to $5,200 to $5,400 rapidly. That is the only short-term read that matters right now. As for trading this, I cannot see a clean picture on the lower time frames right now. I cannot tell you what gold does tomorrow. Nobody can. If you think you know, the tape will tell you if you are right. The environment right now is binary weekend risk, elevated dollar, elevated yields, and a physical floor from Asia that is not cracked. Sidelines is not weakness in this environment. It is the only edge there is. I have called this market both directions. I will call it again when I see it clearly. Right now, I do not see it clearly. The tape decides, not me. Here is the honest truth. Both sides of this trade have a real case, and the one you ignore is the one that will cost you. So let's run both. The bear case is real. DXY at 100.18, and rising puts mechanical pressure on all dollar-denominated assets, including gold. 7 of 19 Fed members now project 0 cuts in 2026. That is the most hawkish dot plot configuration since the hiking cycle began. Core PPI at 3.9% confirms inflation is not subsiding fast enough to give gold a rate cut tailwind anytime soon. The bull case is equally real. Shanghai Gold Exchange physical premium of $10 to $25 per ounce confirms Eastern Central Bank and institutional demand has not slowed despite the Western paper sell-off. Real yields, nominal at 4.26% minus core inflation, near 3.9%, remain barely above zero, which is historically a supportive regime for gold. JP Morgan's published year-end gold target of $6,300 has not been revised. That is on the record. Size correctly. Know what you are in before you are in it. The physical market already knows where this is going. The paper market is still arguing. That argument does not last forever. Everything I showed you today points to one thing. The structural pressure is already built. The physical market in Shanghai is paying a premium that the COMEX spot price has not caught up to. The only question is when the paper market catches up to what the physical market already knows. Don't take my word for it. Verify every number I gave you today. Check the data yourself. CME Group at cmegroup.com for COMEX open interest and gold futures data. U.S. Department of the Treasury at home.treasury.gov for the 10-year yield. U.S. Bureau of Labor Statistics at bls.gov for PPI data. Logic over hype, always. If this analysis added value, like this video right now. Subscribe to OG John AG 1.0 so you never miss a data drop. Share this with one person who needs to see these numbers. The ones running the OG John AG 1.0 playbook do not wait for the mainstream to catch up. They already know. OG John AG 1.0, out.